Hi friends, when trading in financial markets, one of the most important tasks of a trader is proper risk management. Insufficient preparation or mistakes in risk management can lead to significant losses. It's Strifor, and in today's video, we are going to look at 6 common risks in financial markets and how to avoid them. But first, please subscribe to our channel and turn on notifications so you don't miss other useful videos. No matter how attractive the trades may seem, the maximum risk of losing funds should not exceed 5 to 6% of the trader's total balance. This rule allows you to avoid large losses and preserve capital for further trading. It is important to remember that each trade should not be more than 2% of your deposit. This strategy allows you to reduce potential losses and preserve capital in case of unfavorable market conditions. Using leverage can increase both profits and losses. The higher the leverage, the higher the possible profit, but also the higher the risk. For example, at a leverage of 1 to 500, even a small market movement can lead to significant losses. It is recommended to use leverage with caution, especially if you are a novice trader. By default, a leverage of 1 to 100 is suggested, but you can reduce it to 1 to 50 to reduce risk. Each transaction should be protected with stop loss and take profit orders. Stop loss allows you to limit losses when the market moves unfavorably, and take profit locks in profits when the target price is reached. An unexpected news or event can reverse the trend, and without set orders, you can lose a significant part of your capital. Automatic closing of positions by stop loss or take profit helps minimize emotional decisions and protects your deposit. Diversification is the allocation of capital between different assets, which helps to reduce the overall level of risk. Trading several assets at the same time allows you to compensate a loss on some positions with a profit on others. Effective diversification is achieved by choosing weakly correlated assets whose prices should not move in the same direction at the same time. For example, combining stocks from different sectors or currency pairs can reduce the overall risk of a portfolio. The ability to manage emotions is a key component of successful trading. It is important to adhere to a pre-designed strategy and not to give in to panic or excitement, especially in unstable market conditions. For this purpose, even when opening a position, it is necessary to determine the conditions for its closing and strictly follow them, despite external factors. This will help to avoid unjustified decisions and reduce the probability of significant losses. Trading during periods of important economic news releases may be accompanied by increased volatility and low liquidity. At such times, there is an increased risk of gaps. Gaps in quotes, when an order is closed not at the requested price, but at the first available price after the gap. In such conditions, there is also an increase in the spread, which can negatively affect the results of the transaction. To avoid these risks, it is recommended to refrain from trading during periods of key economic news or use protective orders to minimize losses. And if you want to protect yourself even more from risks in the financial markets, watch the first part of this issue, where we talked in detail about risks in Forex, cryptocurrencies, stocks and bonds. Don't forget to protect yourself from fraudulent risks as well. For this purpose, we recommend using the services of proven reliable brokers, such as Strifor. We remind you that we are members of the Financial Commission, an association that unites honest brokers and protects the rights of traders. Thanks to this cooperation, each of our clients is insured up to €20,000. Join Strifor. We always pay.